Good afternoon. The end of the tax year is fast approaching, and your window of opportunity to pay less tax is closing at the end of February, which is next month. In the PSG Wealth Tax-Free Investment Plan, we refer to it as a TFIP. You do not pay tax on your investment returns from capital gains, dividends, or interest. In other words, no tax means you earn higher returns and can reach your investment goals faster. So, this obviously, the idea here is that you do not pay tax when you withdraw your money, and you can invest up to 33,000 Rand a year, which means you make your tax-free account a great investment. So bottom line, what's important is to learn how to pay less tax to the tax man. So good afternoon, everybody. I see everybody's logged in now. My name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. My objective today with this webinar entitled Your Window of Opportunity to Paying Less Tax is to walk you through why you need to take advantage of these savings and how you can do it. So the topics for discussion today, if I can get to that screen, is what are you saving for? Why invest in the tax-free investment plan account? And also just a very basic process how to choose your underlying funds. And I'm going to spend some time on just some of the PSG funds. Okay. So let's kick off. I think everybody's on here. Those of you that logged in a bit later, any questions you have, just type in the question box at the end, and there will be a slot for questions at the end of the presentation. That's number one. And number two, this presentation will be recorded, and I'll be sending you the presentation. So let's kick off. So what are you saving for? One school of thought is with credit so easy to get, why would anyone want to save money and buy with cash? Okay, if you want something, you pull out the plastic and you pay it back with payments over who knows how long. If you can afford these monthly payments, everyone does that. What's the big deal? Now, unfortunately, this is the thing that a lot of people are thinking about right now. This is a lot of the young guys are thinking this way. It's making sense to many, but the idea here basically with saving is we can't predict the future. So saving money can help you become financially secure and provide a safety net in the case of an emergency. So first of all, what do you want to use the tax-free investment for? You can supplement our retirement savings. So next month on the 12th of February, I'll be discussing retirement annuities, but just understand that retirement funding is your number one priority. That's being through a pension fund or a provident fund, even through a retirement annuity. In other words, that's your compulsory savings. A tax-free investment plan, the way we look at it is it must complement your existing retirement savings. Okay, so you can use your tax-free for obviously to complement your retirement savings. You want to save for your children's education. Many parents are doing that right now. You want to use it for a emergency vehicle, savings funds for emergency funds, and then obviously to increase your general savings. So that is basically why you would save it, or why you use it tax-free. It's a savings vehicle, but as I say, to complement retirement funding. So why invest in a tax-free investment plan? The whole idea here obviously allows investors to save more. Treasury hopes that with the tax-free investment savings accounts available now, to help reduce the financial vulnerability of individuals and reduce obviously household indebtedness. And that the overall savings level in South Africa will improve as a result. That is the main reason why they launched this a few years ago. I think it's about 3 years ago now. Okay, so why tax-free? How do you, if you look at that little image on the right-hand side here, how does that make you feel when you're paying a large portion of your investment returns away in tax? So this is one of the reasons why you want to consider tax-free. Obviously, it allows investors to save more, but you pay no tax on your investment growth. And I'll go into more detail just now, but basically any income tax on interest, you don't pay income tax on interest, you don't pay any dividends tax, and you don't pay any capital gains tax within the tax-free investment plan. So it's a great little vehicle. So you don't pay tax when you take the money out either. Okay. So the idea here is it's ideal for a long-term investment. So they say, there's no restriction on withdrawals. Just understand that money withdrawn cannot be replaced. If I and we'll talk about it in more detail in the next few slides. If I put in 33,000, I take out 33,000, remember I've got a lifetime limit of over 500,000. If I take it out now, I can't put it back. Doesn't add to the lifetime limit. And then lastly, obviously, you've got flexibility of contributions. You can stop contributions at any time. Okay, so if you find that in a bit of a pinch, stop, contribute, but remember, you still got your 33,000 for the year. So you stop it now, maybe add it on next month when you've got those funds available. Okay. So let's talk about contribution limits, and this is important to understand. And this is, the idea here is, I mentioned just now, to have that long-term view. So taking that acorn to oak tree approach, contributions are made from post-tax income. Okay, so the individual can contribute up to 33,000 Rand a year. As I say, it's maximum 2,750 Rand a month. Then we got a lifetime limit of 500,000, so, which is roughly about 15 years. Okay. If you go over, there's no further contributions after that time period. Just understand also, if you go over that 33,000 or 500,000 lifetime limit, you'll be penalized. You're going to be taxed at 40% in that tax year. Okay. So just understand, if I've gone over it, I put in 43,000, that 10,000 Rand, I could be paying 4,000 Rand tax on that. Okay. But I know that there are systems in place to warn us beforehand, so we might be able to help in that scenario. Okay. So here's an example, and you'll see the next slide also goes into more detail why you want to go the tax-free as opposed to a voluntary investment. Remember, I'm talking about compulsory money here, retirement annuity. This is not compulsory money. This is voluntary money still. But if you had to put in your 33,000, bring my cursor in here. Where's my cursor? Cool. Okay, so this is the idea that over that 15-year period, I'm putting 33,000 Rand for the year. And let's say, for example, worst case scenario, I'm earning 7% per annum. Okay, you'll see that bottom line, there's my 500,000, all my deposits added up, and I'm growing it by 7% per annum. And as I say, worst case scenario, the total interest I would earn is 446,000, and my balance would have been just under 950,000 Rand. Now, in a normal voluntary investment plan, like a unit trust account, capital gains tax would have been applied. Remember, capital gains tax, your first 40,000 is exempt from tax, but whatever's over that works at 40%. That's the inclusion rate, and the maximum tax rate right now is 45%. So 40% times 45%, that's a maximum. 18% is the maximum capital gains you can pay. In this scenario, you'd have paid 80,000 Rand in tax, just on capital gains tax on this scenario. Okay. That's excluding, obviously, interest and, obviously, the dividend withholding tax. So this is the big difference. And you'll see in the next slide also goes into more detail. Let me just get back to this. Another example where different growth rates, my cursor in. Okay. So the accumulated value of a tax-free investment account outstrips the tax like a voluntary investment plan account. So in this example, there's a few assumptions we made here. Let's say, for example, you open a tax-free and a voluntary investment plan, and you put 33,000 Rand into each one of them. Okay, 33. You'll see that the VIP assumes the maximum tax rate of that the maximum tax exemption has been used, and as I say again, the maximum 45% has been used. You can see in all scenarios. Okay, this is 10 years, that's 15 years, and 20 years. That are doing much better than you've. Remember, this is after tax. Okay, your tax-free would have your tax-free investment plan would have outstripped your voluntary investment plan. So this is where you would fit into your financial planning. Okay. So who is it for? It can be held by a natural person only. So no trust, no companies. And also you can open up a tax-free, and as I mentioned just now, a lot of parents are opening it for the young children. Obviously you just register using all the children's details. But also remember, the tax-free in South Africa, tax-free investment plan is only available for South Africans. And another thing also you must understand, you can have as many accounts as you want to. You can have one with PSG and you can have accounts somewhere else, as long as you don't exceed that 33,000 for the year. Okay, so yes, it's up to you to keep tabs of it. At PSG, we'll be able to say if you had all the funds here at PSG, we were able to help you not exceed that 33,000 for the year. But it's up to you to monitor all your funds all over the place. So, what are the underlying instruments involved? So, there's only a certain amount of a certain unit trusts that are included, and I'll go into more detail in the next slide. Okay, the unit trusts that are included of funds where there are no performance fees allowed. Okay, we call them clean class funds. Okay, so no structured products are allowed, nothing like a PSP or anything like that. No direct purchases allowed, and obviously no conversion from a normal unit trust into a tax-free is allowed. Okay, so those are some of the limitations and the instruments being used to qualify. So I mentioned just now the contributions. I said you can start and stop whenever you want to. But obviously, remember, you can only contribute up to a certain limit, and that's 33,000 for the year. Our minimum investment yet at PSG is 500 Rand a month. Debit order. Remember, the debit order is it's automatic savings, number one, and number two, it's just easy way of just putting money away. And then the minimum lump sum is 6,000 Rand. Okay. There's a wide range of unit trusts available, and I'll explain it in a few slides' time. Remember, only clean classes funds are used. So if I withdraw any funds out of my tax-free, there's no exit fees. You're not going to be penalized. Okay. So how do you go about choosing the fund? So go through it very quickly. On our website, you can click right at the bottom here. You'll see there's a link there. On our website, you'll find the PSG fund list of all the funds available for the tax-free investment plan. There are 12 providers, and there's 56 funds. So the universe is smaller, but it obviously makes it easier to choose from there. So that's your step one. Look at this list of funds. You can look at it, all the PSG funds. There's 7 to choose from, but there's 12 different providers, from Allen Gray to the Coronations to the Satrix, etc. Step one is look at the available funds, and what I've done then is go look at a tool called Funds A to Z, and there's a few steps involved here. First of all, now just to simplify it, in this example, I wanted to compare balanced funds. Okay, so I've looked at 4 or 5 different funds here. I've looked at Allen Gray Tax-Free Balance Fund, the Prescient Balance Fund, from Prudential, PSG Balance Fund, and Standard Balance Fund, just to try and keep a level playing field. The challenge comes in when you start looking at the benchmark. Okay, so they're all the same sector. Okay, multi-asset, high equity. The benchmarks are different, and that's a challenge always when you as an investor want to try and compare different funds. So first of all, just understand, I'm looking in this example, I'm using just balanced funds, and secondly, obviously, remember it's multi-asset, high equity funds. So step one, understand what you're looking at. Okay, so what sector you're involved in, and also it goes into more detail. You can see, okay, inflation plus 6, yeah, it's just inflation. So you can see all these guys outperforming it, and we'll go into more detail in the next slide. Step one, compare the fund overviews, and then you want to compare performances. Same funds now. And you can see over 1 week, 1 month, 3 years, and right up to 10 years analyzed. So some of these funds haven't been around for a very long time. For example, Allen Gray, only been around for about a year. But what I've done in this example, just to keep it simple, I would go through look at each fund and pick which was the best performing, and I'll circle it or highlight it. So, for example, in the last week, Prudential Balance Fund has performed best out of these 5 funds. Okay, remember, I'm only looking at a small sliver out of the 54 funds. I'm looking at 10%, 5% of them. Okay, 15%. Over the last month, they've also been the best performer. For the last 3 months, then we look at Prescient, and so it goes on. Over the longer term, you can see PSG Balance Fund has been performing very well. So that also helps you in determining what to look at. So look at the long-term performance. Then we start looking at things like the fees, and then we look at risk. Okay, so obviously the lowest expense ratio, total expense or total fund expense ratio or expense in this scenario, Prudential will be the lowest out of these 5. From a risk point of view, you can see that these guys have the lowest standard deviation. Maximum drawdown, they're the lowest. And then when it comes to the Sharpe ratio and Sortino ratio, you always want the highest ratios. And the PSG and PSG Balance Fund has the highest in those two ratios. I'm not going to go into detail of these ratios right now. You can always go Google it and look up what they mean and things like that. Okay. So that is basically the process you'd use to compare funds. You want to narrow down the choice, and then you'll choose one or two funds for your tax-free investment plan. If you look at PSG funds, by the way, and I'll explain to you why I'm using PSG funds, there's 7 funds to choose from. You can see they're all clean class funds, and all those 54 funds will all be clean class funds. When I say clean class, there's no performance fees involved. Okay, so you can see with each PSG fund, there are annual fees involved. So you can also understand what you're looking at here. Okay, so why PSG funds? Obviously, when you do it yourself, you have a flexibility of funds to choose from, a range. In this scenario, 7 to choose from. When you go onto our website, you'll click on the individual funds. You'll get the fund fact sheets, gives you more information and things like that. But bottom line, why you want to choose PSG fund is the reduced fees. Okay, on the next slide, you'll see what I mean by that. If you're choosing PSG fees, you'll see that our platform fees is basically working on 35 basis points. If you're using anything that's not, when I say 35 basis points, 0.35%. Okay, that's what you'll be choosing and paying annually as a platform fee. Anything that's not a PSG fund, you're paying 0.57 percent for the platform fee. That difference, it was at 0.225, can add up a lot if you compound it over the long term. So that's the reason also why you want to consider investing in PSG funds. Okay. So guys, just quickly, it's a very short presentation. Gives you time for questions and that. So this summary, remember the tax-free investment plans. It's a simple product because it's very easy from a tax point of view. It's a flexible investment where your returns are not taxed. That's bottom line. That's how easy this product is. You don't pay any tax on interest, dividends, and capital gains. That's number one. Number two, the tax benefits add up in the long run, and this is important to understand. When you invest in higher growth assets, for example, be it equity or be it balance funds. Now, over the last few years, obviously the equity market hasn't been performing so well. The balance funds and income funds have been doing better. So remember, with the tax-free, within that fund, I can switch between the different funds. And there's no tax implications with that. So that's something to take in consideration. But always remember, remain invested for the long term. Okay. Tailor your portfolio to suit your needs. Remember, your asset allocation is flexible. As what I just said now, you can switch and things like that. Regulation 28, like with the retirement annuity, does not apply. You can go 100% into equities. Okay, so that's the advantage here with this tax-free. Remember, again, I said I'm using this as a vehicle to complement my existing retirement savings. Okay, so that's my summary. In conclusion, people, the investment product is geared for growth. The idea is to say tailored for your individual needs and also obviously also your risk tolerance. Okay, it offers you the tax-free investment returns. Take advantage of it. Okay, and then obviously you just understand again that 33,000 a year or 500,000 lifetime. Those are only limitations. Understand with this product. So my call to action today is if you haven't got a tax-free investment plan yet, please consider opening one with PSG. You click on that link to take you through the registration, and it's very easy to do it online from there. If you want more additional information, click on that link on our website, gives you additional information. Okay, so next week, 2 weeks time, we'll be talking in a seminar in Joburg, more about using a receiver as your partner in tax-efficient vehicles. I'll be talking more about the retirement annuities as well as the tax-free. And then obviously the day later, I'll be talking specifically about retirement annuity. Okay, so just go onto our website, go click on events, and then you'll be able to go through to the registration page. Cool. Okay, so let's see what questions are. Have you guys got there quickly? Okay, we go to questions. Wow. So you should maximize this. Okay. Okay, here's a question from Vessel. Who enforces, or how is the 33,000 max per year enforced, especially as the money invested is already taxed? Okay, when you say enforced, 9%, what do you mean by that? How is the 33,000 max per year enforced? That's voluntary. I think, first of all, it's voluntary savings, so it's not enforced. Just understand, if you go over that, we've got systems in place here that we'll see, you've gone over the limit, we will return the funds to you. Vessel, we at PSG Direct Clouds do not provide specific investment advice. If you want advice, you need to go to financial advisor. On our website, you can find there's a button called Contact Us, and you'll be able to find a financial advisor close to you. Unfortunately, we can't give you specific investment advice, but you can bounce ideas off us to say, Sean, I'm looking at X and X funds. What do you think? Okay, and we can bounce back to you. Okay. Question here from a corner. What's the rationale behind the penalty over 33,000 or 500,000 rationale? Because that's stipulations from the Treasury. Obviously, so the rules, we have to abide by it. At this point in time, that is the rules, 33,000 a year, or it was 30,000 until last year, and then they upped it to 33,000, but the 500 always stay there. Well, at this point in time, until they might change it. But to answer your question, it's the rules from the Treasury. There's a question again from Vessel. What if the maximum runs over? If it goes over different providers, the onus is on you, Vessel, to obviously keep tabs of that. But yeah, at PSG, if you had all your funds in one place, we'll be able to see it straight away and return those funds back to you. Whatever gone over the limit. Offhand, I wouldn't know why they have those limits, what they're trying to prevent. I think it's just it's a savings vehicle, but obviously they very I say cautious of opening up a vehicle where it'd be abused. So it might be that. Okay. So here's some more questions here. Can I open a tax-free for my 3-year-old son? That's from Dion. Yeah, you can open for your children, obviously in their details. Just understand that you'll be taking up their tax allowance. Okay. But yeah, the earlier you start for them, the better. You're giving them a good start in life anyway. How many tax-frees can I have? This is from Alicia. You can have as many as you want to. Just understand you need to keep tabs of that 33,000 Rand limit with all the different fund providers. Rather keep your money in one place. It's just easier, I would say. There's a question here from Carol. How do I make sure that I do not exceed the 33,000 Rand limit? Okay, again, monitor it yourself. Cool. I think that's all the questions. Vessel and Lacorna's all happy there. Cool. Okay, everybody understands. Awesome. Cool. Guys, also very important, before I close this up. The deadlines, those of you that are considering opening up and obviously depositing money into the tax freeze, we do have cut-off times because obviously it has to be in before the end of February. So cut-off times need to be met to ensure the instructions are processed timeously to include in this current tax year. The current tax year, remember, goes from February 2018 till now. March, from the 1st of March 2018 to the 28th of February 2019. Okay, that is the tax year. But missing these cutoff dates means the instructions will only be processed for next year, which starts the 1st of March. So all applications and additional contribution forms, all those kind of things, or online submissions must be received by the 22nd of February. Okay, Friday the 22nd, before our cutoff time. And I'll talk about cutoff time below. Okay, instructions must be complete and include proof of deposits. Okay, funds must reflect in our bank account by the Friday the 22nd. If you're doing any electronic transfers, you need to do that 48 hours beforehand. Okay, Please, we have this mad rush every year. People wake up the last minute. Just understand, if you're doing electronic transfer, Wednesday, the 20th of February. So time is, I think, over 3-4 weeks. Okay. The direct debit order instructions must be received by Wednesday. If it's a money market fund, it must be with us on Wednesday by 8:30. All other funds is 10:30. Okay. If you've got any questions, please contact the investment specialist, and this is where you can contact us on 0860 000 368 or email wealth@psg.co.za. Okay. Guys, I hope this was beneficial to you. You learned something, but just understand it's a very simple product. Bottom line, there's no tax. Use the receiver as your partner in this product. Great little savings vehicle to use. So from my side, thank you very, very much for attending today. Until next week or in 2 weeks' time, keep well. All the best. Bye for now.